Welcome to the daily update where I'll go over the action in the market for Thursday, August 21st, and we'll see how things look for Friday, August 22nd. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. Very choppy day. If you're a day trader, it's probably a good day. You can get small little profits trying to buy the dips, selling when we go up a little bit. But we are tending to drift lower, and we're still seeing the market shift over and look more defensive. Now, a lot of eyes are pointed to Friday. Pretty much the big event, unless something else happens that's unforeseen, is going to be Jerome Powell's speech at Jackson Hole, Wyoming. That's had a real impact, especially about 3 years ago. It was in 2022 when the market was headed in one direction. He came out, gave his speech. It was produced a real reversal after that. And so folks are a little gun shy ahead of this speech that we see coming out here, but it might actually work the opposite way. We're still leaning a little bit positive. Now, in the short term, I've switched it over to negative because we have closed slightly below the 20-period simple and exponential moving averages. That's how I measure the different trends, whether we're positive or negative. We're not falling apart, but we are seeing the market shift from a growth stance over to a defensive stance. We're also in a weaker seasonal time, and that seems to be kind of playing out. But we're not seeing massive declines at this point, and we're seeing some buying on weakness, but we really have no conviction right now. We're leaning a little bit more negative in the short term. That's why we're dropping down below the 20-period moving average. The intermediate term is still positive, and things are holding up, even though there's some weakness drifting in there as well. And the long term is still looking pretty good. Okay, so right at the open, we ended up having a lower open. We opened below the daily pivot at 63.83, so we're down below 6,400. But we were able to find support at S1 at 63.57. Before rebounding back above the daily pivot, but then we hit resistance at the unchanged level. And as I say, we've got our R1, R2 level, S1, S2 level, the daily pivot. The unchanged level is a built-in support or resistance level each day as well. And that's about where we topped out before we started chopping between the unchanged level and S1. Then prices rose and then chopped around the 63.75 level, and we closed right around the 63.70 level. So a lot of choppiness, not really any conviction, and which is tending to drift things a little bit more negative because we are closing down. We were down 0.4%, not a huge percentage move, but we're just seeing this rotation, this shift that's going on in the market. And we're wondering, is Friday going to clear that up? Is it going to confirm and then we're going to continue to become more defensive? Or is the market going to shift gears and start to see things more positive and go back to a growth stance? And we're still below average with volume, very common in the summer months. So we're negative now in the short term, positive in intermediate and long term. Interest rates kind of not really moving around, not having a big impact right now as far as the stock market. And the market is now just keeps going with this inflation scenario that maybe that's a problem. And that came out a week ago when PPI was released, and it's been kind of going with that scenario ever since until we see something else that either confirms that or contradicts that and has the market develop a modified scenario of what's actually happening. All right, so some comments. We're slightly below the 20-period moving averages. Now, I use both a simple and exponential. Some folks prefer one over the other. I use them both, and we're slightly below both of those now. We did have some Fed speak that came out. Kansas City President Schmidt, who's a voting member, said that he is not in a hurry to cut rates, This is not really what the market wanted to hear, citing several key inflation readings that will come out between now and the September meeting. And we still have a little less than a month now until that meeting, and there's going to be a whole slew of economic reports that are released. Then Cleveland Fed President Beth Hammack, who doesn't vote but is still on the committee, stated that she sees no imminent case for rate cuts as inflation remains too high. Market didn't want to hear that either. So mega caps and tech, they're underperforming yet again, and we're seeing that continue. That's been building throughout the week so far. Other than Monday, we had a pretty good day then, but Tuesday, Wednesday, and even into Thursday, we're seeing this shift over that's more defensive. And we've been seeing it more gradual going back about to the beginning of July as well, but not continuous. It would happen for a day or two and then kind of go away, then it would come back. And so the market is just kind of setting itself up in this more defensive posture. So, Powell's speech, that's the big deal. And there's no economic reports coming out. And as I said, unless something else happens that does have an impact on the market, that's what the market's going to be focused on. And we already have the StochRSI, which is extreme negative. We have nothing that's extreme positive. Even the stochastics charts, which are usually always on the list, either positive or negative, they're not on the list right now. The only thing that's showing any kind of conviction is more to the negative side with the StochRSI. And we'll see if Friday actually changes the overall scenario as it relies on the Fed. Is he just going to come out and say, wait and see some more? That's really not going to give the market much direction. But it may be also what it wants to hear and say, okay, well, they're not really freaked out about things. Maybe we can be more positive. Or it's like, well, they don't really know what's going on, so we can't have confidence in that, and the market may turn more negative. The dollar was up slightly, and we are showing some improvement there, and that could be pressuring stocks. Now, the dollar's in a downtrend, but as we've been coming up out of the lows from April, the dollar declining, that has helped stocks to go higher. If we do get to the point where the dollar shows more continual strength instead of just going up for a few days in a row, that may end up pressuring stocks as well. And also interest rates. Now we're below that 4.5% level at 4.33%. If we start to tick up because inflation is more of a concern, we get up to that 4.5% level, that could also pressure stocks, but we're not there yet. We're just keeping an eye on that. Sentiment, we're back down to neutral. We had been positive, we were ticking down. We saw a little bit of an improvement. Now we're going back down into the neutral area at 56. So the overall context is that sentiment is becoming more negative since it's been declining. And we are positive with the trend. We haven't crossed over yet with the green line and the red line. The green line actually went up a little bit, and that's a bit encouraging there. But it is a weakening trend since we're below the moving average, but we're still above 20, so we are trending. And now I believe this is the fifth or sixth day now that the S&P has actually been down. Some of those days were not big down. None of these moves have really been all that much. They've all been on a percentage basis, not all that great, but it's been a gradual shift. And I'm keeping the momentum right now. I was mixed to positive. I switched it over to mixed because we're just, yeah, there's some positive things that are happening, but the last 2, 3, 4, 5 days that we're taking together, we have seen things shift over. I could have even switched this to negative, but since the intermediate and long term are holding up a little bit better, I decided just to keep it at mixed. All right, we had probably the biggest economic report day of the week right now, and we every week we get the initial claims. Now they spiked up, and this was not very encouraging to the market. We're at 235,000. We'd been around the 220 to 225 range. Well, now we're up into the 235 range, where last week it was 224. And continuing claims are also going up. Now we're under the 2 million mark, but we're still getting a consistently high reading with the continuing claims, which feeds more into the scenario that companies are more reluctant to let people go initially. But those people that do lose their job, they're having a more difficult time finding another job and they're staying unemployed longer. Philadelphia Fed Index, they thought it was going to come in at 9. It came in down 0.3. Last time it was at 15.9, so weaker than expected there, but that's more regional. And the global US manufacturing PMI, it did come in back above 50. This is kind of encouraging, but the market may take this as inflationary. Now, this is global. The one that the markets really pay attention to is the just within the US itself, not so much on a global scale. But when we're above 50, that's showing expansion at 53.3. Last time it was at 49.8. When it's under 50, that shows contraction. So there is some improvement there. And we did tick down, but we're still above 50 with the services PMI at 55.4. Last time it was at 55.7. So not as much of a decline there and still above 50. So that's looking relatively healthy. Existing home sales were more than expected, 4.01 million. They thought it was going to be 3.92 million. Last time it was 3.93 million. Leading indicators, and I have a chart to show you there. It was down as expected, 0.1%. Last time it was down 0.3%. So here are the weekly jobless claims, and then we watch the 4-week moving average, and they're going up. We're still range bound. We've been at these levels before, and then we started to drop back down from that. We'll see if there's more of a continuation. But really, over the last few years, we get to the lower end of the range, and we get to the higher end of the range, and we work our way back more to the middle. This is the thing that's a little bit more concerning. We broke out of the range back in about April or May, and we're consistently seeing higher than expected continuing claims. So we put that together with the latest unemployment rate at 4.2%. The red line are the initial claims, which are going up, and the continuing claims, which are up and getting up into a higher range. This also shows us both initial and continuing claims rose by more than expected. The former remains within its recent range, but the latter is made. This is what I just said here. All right, so the initial claims are range bound, where we're seeing this higher range finally after breaking out. This goes back further now than the chart that I showed, and because we get such a skew from the COVID when everything was shut down, it's really hard to make sense of some of these charts. And then we are down just slightly here with the Philadelphia Fed index after it had been positive. And then looking at the flash PMIs, the global flash PMI rose to an 8-month high. That's showing strength. That's showing expansion by renewed improvement in manufacturing, which signaled the best factory business conditions since whenever. And job gains in the sector reached the highest since whenever as well. So this is showing some improvement looking at this particular chart. Here's the LEI, the leading economic index or leading economic indicator. We're still seeing a drop off with the blue line. That's looking out into the future, where the coincident reading here, it's flattening out, but it has been declining. That's more how things are right now, where the blue line tries to project things looking forward. And then they develop this chart here where it says the LEI's negative growth rate and low diffusion index over the past few months triggered the recession signal again in July. That's when we fall below the red line. And we did fall below it. We did go into a recession back in 2020. Then in 2022, we fell below the red line, but we did not go into a recession. And we're still below the red line again, even though we're turning up slightly here. And that is when this chart tries to suggest that, okay, a recession is more likely when we're below that red line. And typically that's what happens. We'll see if it works out similar to what we saw when we dropped below the red line back in 2022, or if we do in fact go into a recession. Even with the market becoming more defensive, we're seeing a little bit of weakness with some of our ratios, but the market's still anticipating that we will have a soft landing, meaning that we will not go into a recession. So here is the real investment advice forward earnings estimates against the S&P. They tend to really go along with each other. And this is a longer term chart. It goes all the way back to 1999. As earnings go up and estimates go up, the S&P goes up because that's ultimately what drives stock prices. Then concentration in the S&P 500 market cap and earnings in the 10 largest. Okay, we've got the 10 biggest companies. Now we have the Magnificent Seven, the Great Eight, the Illustrious 11, whatever you want to call it. But most of the market cap is concentrated in the bigger companies. And when they're not performing well, the indexes are more sluggish, where the earnings are also going up, showing here at 30%. Short interest, this is when folks go in and they actually short the market, where most of the time when you go in, you buy low and sell high. That's called going long. when you initiate a new position and you sell to get in. I know that doesn't make a lot of sense to people. How can you sell something you don't own? Happens all the time in the stock market because you want to be able to buy it back at a lower price. And if it does go down and you sold at a higher price and you buy it back at a lower price, that's how you make it your profit. Coming down a little bit after we had been really seeing this going up as the market was going down. Now that's the negative side. Now again, these are not that big of percentages as far as people that directly short the market. Because as I say, whenever we see this chart, we have other alternatives. There are put options that are less risky, that you can still benefit from the market going down. There are inverse ETFs and mutual funds that you can use when the market's going down that are less risky. It doesn't mean you're going to have a gain. It's just when you go out and short the market directly, there's a tremendous amount of risk there because theoretically, there's no limit to how high the market can go. And so the requirements are a lot different. The margin accounts, it's calculated. And then if you start losing money, you've got to get out of the market. And since you sold to get in, you have to buy to get out. And that produces like a sideline of built-in buyers. So, but we did see this coming up, but it seems to be stabilizing currently. Market implied U.S. recession probability. I mainly look at the average. We're at about 18%. So the market is not necessarily concerned. Some areas of the market, like over 52% here with the implied change in the Fed funds rate looking forward, that's a little more dangerous. But then we have other areas of the market here which are showing a lower average. And then the fact that we're in a recession right now, that's coming in at 2%. So we're not there yet. Then the current level of the Fed funds rate is in line with policy rules. There's this blue cloud here that moves around, and this is where the Fed is at. So according to this chart, what the Fed is doing lines up with what should be happening now. And I know President Trump, he wants the rates to be lowered, and generally people want lower interest rates. But looking at this analysis of the chart, it's considered to be about where they should be. And typical path for analysts' earnings per share estimate revisions, and they're actually going up a little bit now after they had been declining. And this is very common when, if you're an analyst and you're looking out to 2026, 2027, you're going to be more rosy there. And they're actually revising them out or up a little bit here going out to 2026, where the typical route of this is that they have very rosy projections and then they tend to decline as we get closer and closer to those dates becoming the front dates where earnings will be released. And that's very common there. And then retail activity, it's actually dropping off. So we're seeing retail investor behavior change during the tech selling in the past 2 days, breaking the 2-month long buying streak to become net sellers. Back on Tuesday, they prioritized profit taking in single stocks while dip buying in the broad market ETFs. All right, so we're actually seeing things coming down right here. And then the retail imbalance, stocks and ETFs, where we do have more people in ETFs, and that's mainly what I focus on and teach in the program that I have, rather than individual stocks. I prefer to work more at the index level, mainly because we get huge studies, a number of studies like this, and we get more information that we may not be getting from individual companies. Then they're always trying to compare the 1990s to now. Okay, this is how they're tracking with each other for the most part. So the NASDAQ continues to eerily track the mid 90s bull run. And I got into the market in the early to mid 90s. So I was kind of dealing with this as well. This is when I decided to switch over to the index level because these stocks were $300 a share for this .com stock that not too long into the future were at zero. You could actually get more money by selling the stock certificates on eBay. It's up more than double, 106% since we hit the low in December 2022. Close to the index's 100% 11 or 111% gain over the same period in 1995. So, yeah, I mean, you could say we're in a bubble. there's earnings behind these companies that are there now that weren't there back in the 90s. They were just dreams at that point. This is when the internet really started to kick into gear, and it's like, oh, we can have these all these companies online and people can buy things and everybody's going to make all this money and it's going to change the whole way we live. Lot of good ideas, but they just didn't really end up working out. Then revisions here also showing coming down with the revisions in this top area with the small caps. And let's see, I need to move this little bar right here. Earnings per share revisions just turned positive. Okay, so we're seeing this coming up a little bit here, but this was back in 2020. I don't see where they're okay. Earnings momentum has turned. The revisions just went positive for the first time. Both times, small caps ripped higher. Well, we really have yet to see that. When you look down here at the bottom, that's where we're turning positive. But overall, we're seeing things continue to decline. And if you look at the Russell 2000 index and do a PE ratio with that, it has us already well up into the 20s. Now, either price is going to have to come down for that PE ratio to come down, or earnings are going to have to go up, and that's going to bring the PE ratio down as well. And maybe we're starting to see some of that happening currently. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. All right, here is our chart. Very choppy day. We gapped lower down below the daily pivot, came almost down to S1, bounced up, but then we could not go positive here. And then we just chopped around the daily pivot, chopped down below it, and then went sideways for a while, came back down to S1 again. This held as a support level, and we went back up. We're range bound for a while, tried to go up a little bit higher, and then drifted down going into the close. Not an awful lot of conviction happening there. And not much of a change. There's a lot of wait and see about is Powell going to say, we're going to wait and see. So we're wait and seeing about wait and seeing currently. And the one thing that I have been noticing though lately is we're seeing most of the price action while the stock market is open. And so we do see some gaps here and there, but most of the price action is actually taking place during the trading day instead of either a gap higher or a gap lower that like we were seeing last spring, where we would get most of the move from one day to the next at the open. Then this is still more defensive here. Now the red line's holding up a little bit better. That's the intraday growth, intraday value. And that's not doing great, but it's outperforming the blue line, which is large cap growth. And that's been underperforming lately. Also showing where the market is becoming more defensive. And we're continuing to go down here with the S&P growth to value ratio intraday. We're still below this green moving average here, and we're trying to bounce back up, getting above these shorter term moving averages, but overall it's been showing more of a decline. And we started to top out and then go sideways here earlier on in August. End of day charts down more with growth and value for the large caps, down less with the mid caps, and growth for small caps was actually up where value was down. So just continuing to be range bound here with small cap growth to value, still below the 50-day moving average, but in a longer term uptrend with mid cap growth to value, and further declining here with S&P growth to value. But bigger picture here, we are still in an uptrend, but we are seeing some weakness. And when this ratio goes down, especially when it drops below the moving averages, that also suggests the market is becoming more defensive. And when it becomes more defensive, that's when the market is folks are feared that we're going to go down, even though we're not seeing really big moves yet. Also coming a little bit further into the rainbow with this growth to value ratio. This is going back up. This is a value to growth ratio. Also showing how the market's becoming more defensive here. And then looking at discretionary to staples, we did pull back here with the equal weight version, but we're still in a longer term uptrend. And then looking at some different measurements of growth versus value here. This is the weighted version of discretionary to staples. just kind of tending to drift higher, but seeing some recent weakness, even though it ticked up a little bit. When we look at the equal weight version, we are seeing more of a decline. Also, we've been declining when we look at tech to utilities, a little bit of a bounce lately after declining with biotech, which is growth, to healthcare, which is value, and still declining here when we look at hotels to utilities. So our trend, it looked like we were getting ready to cross, and we're still close. If you look over here, the green is at 2365 and the red is at 2309. So the green value is still just a little bit higher, so we're hanging on to a positive trend here. But it's a weakening trend since we're declining and we're below the moving average. Also declining below the moving average in the intermediate term. Also, the green line continues to be above the red line, and the red line actually declined. Still below average with volume, and we're continuing to see pretty much every day, with few exceptions here, that we are below average as we work our way through the summer. Are coming back up with the VIX, still below 20, still below the moving averages, both with the line chart and the bar chart. And this has been updated now. So we see a little bit of spike in the VIX and then it comes back down. Now, are we going to start to see it go up from here? That's seasonally what has happened. And then the red line is what is happening right now and how we're tending to match up with that, at least to this point. But it could deviate at any time. And we are seeing a bit of a pickup in volatility when we look at the volatility of the VIX, or the VIX of the VIX, above the moving averages with the bar chart as well as the line chart. And we ticked up here with this fear gauge, and we ticked up a little bit, but not much of a change here with this other fear gauge. So some slight confirmation there that some fear is starting to come back into the market. Then every Friday we get, at least when I do the Friday video, it comes out on Thursday. It actually comes out before that, but this chart isn't updated until later in the week. Seeing a little bit more negative responses here when we look at individual investors. It had dropped from the previous reading. And we came down a little bit with the daily chart of the equity put call ratio. We're declining with the 5-day chart, and that's considered positive. But now we're starting to go back up with the 10-day chart, which is considered to be more negative. And still tending to decline here when we look at the risk off to risk off ratio. When we were coming up out of the April lows, this ratio was really going up. Then we started to gyrate around, and now we're starting to come down. If this continues, that'll be more negative for the market. Still at the high end of the range here when we look at volatility risk premium, but it's not really spiking up right now. And we did decline with the advanced decline line based on price and volume. Bigger picture is, though, we are still positive. We declined with the advanced decline ratio, but still above zero. And we did decline here with the advanced decline oscillator over the last 10 periods, but we're still above zero here. Still going up with the 5-day and 10-day chart of the new highs minus the new lows. Not seeing much of an expansion of the new lows. It's more of a contraction of the new highs. And we're positive when we look at accumulation distribution in the bigger picture here. It's above the moving average, but we continue to decline on a shorter term basis here with the boom indicator. And we're flat right now with the chicken money flow. You can see not a lot of conviction once we got into August. And this thing tends to move, but it's not been moving very much lately. And we're back to declining. We went up in Wednesday's session, but we didn't get back above the moving average. Now we saw a little bit of a decline back below the moving average here with the Chaikin oscillator. And this was showing some weakness as well. And the green line actually went up with the vortex and down with the red line. So that's showing a bit of an improvement. And even though we're declining with our advanced decline line studies, we're still above the moving averages with all of the indexes. We're still above 50 with those stocks above, or those stocks in the S&P above their 20-period moving averages, even though it declined a little bit. Not an awful lot of conviction in the short term, but hanging on to being positive this way. Declining, but still above 50 with the 50-period moving average study. The 100 declined a little bit, as did the 200. But they're all positive since they're still above 50. Here's the chart, and you notice the pivot points here. We got up to that level. We tried to break a little bit above it, but that's about where things topped out for the time being, and now we're starting to come down. Now, not too far below where we're at is another pivot point for August. Is that going to be able to provide some kind of support? And we really dropped off with volume here. And where we saw a bit of an improvement after Wednesday, well, we saw a little bit of deterioration here with the moving average study based on 20, 50, and 200 periods for the S&P. We are starting to show a little bit more negative conviction now with the StochRSI. We're declining below the midpoint with the Williams percent R. The CCI 14 is below the midpoint, as is the CCI 20. And the short-term stochastic is now dropping below the midpoint. We're declining with the intermediate short term, and we're just dropping below 80. We're at 79.61 here. So we're not extreme with the long short-term stochastic, but you can see here clearly all three of these lines are more negative. And we're negative here with the force index, seeing more vulnerability to the short-term trend. We're below the green line and blue line, and so now they're starting to roll over as well. And we're just a little bit below the 20-period simple and exponential moving averages. And we're right at the midpoint here with the standard deviations chart. And this is interesting, though. We're seeing kind of a positive divergence here, where we've been coming down with the S&P, but the balance of power is showing some strength. It's above zero and continuing to advance. And we're more negative or maybe neutral with the lighter blue bars here with the go, no-go system. Right at the midpoint again here with the highest high, lowest low value chart. Now we're on day 78 of the Landry Light trend measurement. That's more of the time there. We're still positive with the proper order. We're still looking more negative though with the TTM squeeze, darker blue and declining. And we were slightly below zero with the easy movement. Now we actually ticked up and came back above zero after Thursday. Did see a drop off here with the Arun where the buyers are decreasing and we're seeing some sellers starting to come back in. However, we're still positive with this since we're above zero, but the context is now that we're declining. And we're back below zero again here with the S&P McClellan oscillator. And so we're going down based on price and we're going down based on volume. So now we're seeing a bit of confirmation, but you can see how choppy this has been right here. Just not really showing an awful lot of conviction once we got into August. And we're below zero with the NYSE McClellan oscillator. So we're rolling over here based on price and volume with the summation index for the NYSE, negative with the Swindler trading oscillator. Starting, well, just barely positive, but we could be going negative here quickly. Where based on volume, we're actually dropping below zero, and that's also declining. Now, our momentum indicators, which were showing some improvement, now they're starting to deteriorate here. So we're rolling over with the PMO, and we're flat here based on price, where we're actually turning down a little bit more based on volume. So we're still seeing volume leading price, but this time to the downside. And we're declining and starting to drop below 50 with the PMOs that are rising, but the buy signals were right at 50 here and starting to flatten out after we were improving with the PMOs that are above zero, negative with the Elder's Impulse system for the S&P, and we haven't dropped enough. We probably need to clear this low that was set in Wednesday's session for a dot to come in on top. So for right now, the parabolic SAR is holding up and it's still positive, where we're just kind of drifting a little bit lower here with the short-term slope oscillator. We're actually looking more negative here with the MACD. So now in the short term, turning more negative as we're going down, rolling over here in the intermediate term. We never did go positive in the long term with the tricks in KST, and they're starting to drift lower again as well. We're still hanging on to barely being positive with the Copic curve, but it's been flatlining for the last few days. Declining here with the Sean trend meter, still in the green area, but the context is that we are declining. And we did decline, very choppy here with the ultimate oscillator, but still above 50. The money flow actually went up a little bit and is still above 50 as well. So they're counted as positive. The ultimate oscillator and money flow, when they're above 50, that's the line between positive and negative. And for the first time in quite a while now, we're starting to drop below the moving average with unbalanced volume. Declining, but still above 50 with the intermediate term RSI, but now we're dropping below 50 in the short term with the 9-period RSI. And kind of in between the moving averages here, below the green, above the blue, right at the red or orange line here with the bow tie method. and seeing a little bit more vulnerability, but holding up. We haven't quite rolled over yet with the intermediate term trend based on 50 periods. So we're just a little bit below the 20s, but we're above the 50, 100, and 200s, and these lines are still going up. And if we do drop a little bit further, we'll be watching this anchored moving average here from this breakout that we finally had. So far, we're still above that level. And we're declining now again with the bullish percent index. We've dropped down below the moving average. Now we're still above 50, but the context here is that this is declining. Also declining with the NYSE bullish percent index and flat below 50 with the NASDAQ 100 bullish percent index. Still getting a praying bottom fisher, but not after it's been seeing a really deeper signal here. But this is a buy signal, but I wouldn't use this all by itself. You need to have some confirmation with other charts. And we're still dealing in this little mini rainbow here. When we look at the 20 period simple moving average of the open, high, low, close, last couple of trading sessions, we've been inside the rainbow. And this is actually what you call an inside day, where on Thursday we were not able to get above the high, nor did we break below the low. So that also shows a market that's rather indecisive right now. And we're still below this R1 pivot point, which is at 64.68. We're now at 63.70. So we're about 100 points away. And still at the upper end of this long-term trend channel. And about the time we hit this is when things started to slow down. And we're looking more negative here with the hike in ASHI. We're still positive since we're black, but we're continuing to point down with the KEGI chart. The Renko chart is still positive, but now we're starting to see the three-line break chart turn more negative. Long term, still looking okay though, with our 150 and 200 period moving averages, and still negative with the NASDAQ 100 in the short term. All the other stock indexes are positive, and bonds is kind of weird here. Negative in the short and long term, but positive in the intermediate term. Commodities are positive in the short and long term, negative in the intermediate term, and now starting to see a positive trend in the short term for the dollar, which if the dollar does continue to go up, that could add more pressure to stocks. Everything was negative except for energy and materials. Energy is considered to be more defensive. At the bottom, we had staples, which actually underperformed discretionary, even though both were down. Utilities were down as well. But you can see none of these were more than 1% lower. It was just kind of a gradual drift down lower. And we had a bullish MACD crossover right after the open with the energy sector. Then we had the NASDAQ crossing below 21.1. And then the euro, a bearish MACD crossover. That's against the dollar. And if that continues, that could suggest some strength in the dollar. And Canada still holding up a little bit better there. And then discretionary had a bearish MACD crossover as well. That's a more growth area. In fact, that this is turning more negative is a bit of a concern. A lot of red in here and not big changes. None of these areas in tech were down more than 1%. In fact, they weren't even down 0.5%. Where Amazon was down, Tesla was down. That's discretionary. In the communication area, Google was up slightly, but Meta ended up declining as well. Then Walmart came out with their, I think, did they already come out with their earnings or are they going to report? They got hit pretty hard after that, where Target got hit pretty hard the day before. And we're seeing this ratio coming down when we look at the weighted versus equal weighted version of the S&P. That also shows that the equal weight version is holding up better than the S&P index itself. And the Dow, now we're dropping a little bit below this R1 pivot point, but it's been just kind of drifting along sideways as well. Neutral with the Elder's Impulse system for the diamonds. And we topped out at about this R1 level here with the NASDAQ, and now we're starting to come down. We're still maintaining support at this pivot point. We didn't get back down to it in Thursday's session, and we're still in a longer-term uptrend. Maybe what happens on Friday will determine whether we break above this pivot point and hold above that level, or are we going to break down below it? If we do break down below it, we're going to be watching the 50-period moving average as a potential area of support. Negative with the Elder's Impulse system for the NASDAQ. Also, we did drop down a little bit below the pivot point, but now we're maintaining price above that, and we're getting closer to the 50-day moving average with the NASDAQ 100. Negative with the Qs, with the Elder's Impulse system, Momentum is negative for the NASDAQ 100. We lost the short-term trend based on 20 periods with the QQQs, which is the ETF for the NASDAQ 100. We're still above the 50-period moving average. Is that going to break below this? And this could actually lead the S&P if we do break either lower or higher, because the QQQs are growth, where the S&P is a mixture of growth and value. And coming back down in here to the trend line, going back to 2009, we'll see if that holds or are we going to break down below it. And getting really close to a golden cross with the small caps. We still are above both moving averages, even though we had a couple of good up days and we've been drifting back down. But since price is above both of the moving averages, they continue to improve. And we are in an uptrend with the Russell 2000 small caps, but also been drifting down after we saw a couple of good up days. Neutral with the small caps with the Elders Impulse system, still above the pivot point with the mid caps, and going from neutral back over to negative now with the mid caps with the Elders Impulse system, and drifting down a little bit here with the broad market measure using the Wilshire 5000, also drifting down with the total US stock ETF. Financial sector was down 1/3%. It's still above its 50-day moving average. Still seeing a bit of an improvement here. This is kind of encouraging, but we need to really break above these moving averages when we look at the financial to S&P 500 ratio. This has been a concern to us, wondering, is this some kind of a warning sign? Now, if we do improve with this ratio, then okay, no, I guess not. But we haven't really broken this pattern that we've been seeing with this going lower, at least yet. And coming down to the 50-day moving average with the FANG index. These are the really big companies. And so far, this support level is holding. So Apple was down almost 0.5%, and we had Amazon down 0.83%, back down to its 50-day moving average. Microsoft also dealing with its 50-day moving average. Meta dealing with its 50-day moving average. Google coming down, but in an uptrend. It was actually up 0.22%. Tesla chopping all over the place, down over 1%, coming back down closer to its 50-day moving average. And Nvidia also still above its 50-day moving average. It was down 0.25%. Netflix still below its 50-day moving average. And now the moving average is starting to flatten out right now. It was down 0.63%. The semiconductors, though, are still holding above their 50-day moving average. Now, other charts that we look at for semiconductors, they're not doing as well or as much. They're not really hitting support here. That's why I picked this one out, the SMH Semiconductor ETF. So far, we're holding above this, even though we were down 0.5%, and coming a little bit more into the top end of the rainbow with the SMH Semiconductor ETF. Going back up here with the staples to tech ratio, that means the market is getting more defensive. And coming back down into the top end of the rainbow, we were kind of encouraged that we were coming out of the rainbow when we look at home construction to 3 to 7 year bonds. This is what started to fall apart at the end of 2024, and it's been improving, and we're hopeful that maybe this ratio will start to improve, and that could help the overall home construction arena. So looking at our different bellwethers, kind of dropping down here a little bit with the semiconductors, but still not really declining all that much. The home builders are starting to see some weakness. That's the home builders all by itself. The previous chart was a ratio of the home builders to 3 to 7 year bonds. Also seeing some pullback here with the transports, retail, and still going sideways with the regional banks. And a little bit of a drop off here with US to world stocks and the short-term correlation still tending to go up, but leveling out with the longer-term correlation. And we were back up with oil. We're getting more into the mid 60s, and the dollar is up again here. Now this shows it as down because it trades 24.6 here, closes down over the weekend. But when we closed with the stock market on Thursday, we were showing some improvement here with the US dollar index. And still down here below this red line here when we look at the 10-year yield. If we get back up to this area, that could put more pressure on stocks, but we're not there yet. And we're continuing to see it really choppy with a gradual downward move here with the 10-year based on price. And we're seeing some weakness here. This also shows the market's getting more defensive. The Qs to S&P dropping down below the moving average. And now the moving average is rolling over. We're declining, but still above the moving average with discretionary to the S&P, but we're down below the moving average when we compare large cap growth to value. So with all the indexes that we follow, large caps, mid caps, small caps, we're below the moving averages with the growth to value ratios. So we're still looking ahead here to the symposium has already started. It's Powell's speech that everybody's waiting for, and that will happen on Friday. And okay, I should have changed this. We're actually negative in the short term here. We're still positive in the intermediate and long term as the market is becoming more defensive. We still have, if we start to go up, we still have overhead resistance, not only for the S&P, but we're seeing it for the NASDAQ and NASDAQ 100. And we're seeing it on the daily side and on the weekly side with the S&P 500. And this is the only thing happening. And that's not even an economic report, but it's kind of a big deal for the markets there. And then anything geopolitical that may develop that might have an impact on the market there. And then we're finishing out the economic calendar for the week here. And that's about all that's happening on Friday. Seasonally, neutral to positive, but not much of a real advantage one way or the other. When we look at August 22nd, going back to 2002, we are starting to finish, we will be finishing out the options expiration week the week after, which tends to be down more than up. And here is some negative seasonality here. We look going pretty much into the rest of the month during a post-election year. We have yet to be positive in August going back to 1950. This also shows how post-election years are usually negative. This has been updated too as we've been rolling over with the S&P, and this also shows a little bit longer term negative seasonality. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. So I still have the smart money indicators over here on the negative side. We're mixed with accumulation distribution. We're above the moving average with the main indicator, but we're declining with the boom indicator. We're flat with the Chaikin money flow, and we're negative with the Chaikin oscillator. And now we're below zero with the McClellan oscillators for the S&P and NYSE, which is now sending the summation indexes lower as well. Swung and trading oscillator is negative. The momentum oscillators are actually they're turning more negative. The Copic curve is still a little bit positive. And the bullish percent indexes for the S&P, NASDAQ 100, and NYSE are also declining, with the NASDAQ 100 BPI actually still below 50. And the momentum for the NASDAQ 100 is back to negative, and we're still on a Zahorchak method sell signal at a -6. Positive sign though, even though our growth to value ratios are taking a bit of a hit, they're still positive in the longer term. Discretionary to staples is still looking okay there. And the parabolic SAR, we haven't seen enough of a drop yet for that to turn negative. The ease of movement is actually back over on the positive side now where it had been on the negative side. Then we have the money flow and ultimate oscillators. Those are both above 50, so they're considered to be positive. The Vortex did see some improvement. That was probably one of the better looking indicators that we saw in Thursday's session. And the financial sector is still continuing to underperform the S&P 500. And we do have a praying bottom Fisher buy signal. Okay, and then our longer term special K oscillator continues to be positive there. Here are the pivot points for Friday's session. We'll see if we can break to the upside, downside, or if we're just going to chop all over the place and not show much conviction like we saw on Thursday. So our conclusion, now, again, I should have changed. Let's go down here. I did change this lower. We are negative now in the short term. I neglected to change this here, but we're still positive in the intermediate and long term. As the market is becoming more defensive, if we do go up, we have overhead resistance to be concerned about. Intermediate term, we're still positive, but we're seeing some weakness there, but it's holding up better, and we continue to be positive in the long term as well. Thank you. I really hope you found this helpful. I hope you have a great day on Friday, and I will talk to you in the next video.